Welcome to This Week in Money. I'm Jim Goddard. Today, Ross Clark from chartsandmarkets.com checks out the major markets. Once again, the major North American markets hit record highs. He takes a look at the trading pattern that's happening right now and how the upward trend could change shortly. He also has a special offer for our listeners. Just retired but still very active BC trader Victor Adair gives us his take on why the markets continue to climb and what he believes is happening with the US and Canadian dollars, gold, and commodities. Market historian Bob Hoye looks at surging home prices in the US and UK and answers listener questions about the Fed trying to keep things afloat, what kind of correction the markets might experience, and will the next crash be announced by an inverted yield curve. Plus, at the end of the show, we'll have a company showcase update from American Manganese President Larry Reaugh. We'll talk to Ross Clark right after this.
Media recognition from Bloomberg, Reuters, recycling trade publications. Patented process for 100% recovery of critical metals, including cobalt, lithium, nickel, manganese, aluminum. American Manganese is focused on recycling lithium-ion batteries for electric vehicles. American Manganese trades on the TSX Venture, AMY, the US, AMY.V, and Frankfurt 2AM. For more information, visit AmericanManganeseInc.com or phone me, Larry Reaugh, at 778-574-4444.
Welcome to This Week in Money, the source for market opinions. Here is Jim Goddard.
My guest is Ross Clark from chartsandmarkets.com, where you'll find insightful market commentary and timely technical analysis. You can find him on Twitter at ChartsByRoss. Welcome back to the show.
Good to be with you, Jim.
The major North American markets again hitting record highs. What's the story there?
It just keeps on going, doesn't it? And it's the ever-ready bunny here. Our model for the year was that it was going to be strong right through until probably July. That's normally you get a little bit of a hiccup in May or early June, but the high is out there in July. And there's a time window historically. If you look at the S&P the last 50 years or so, there's a window here between the 27th of June out to the middle of July. The 13th to the 18th is sort of the window. The S&P's been up 73% of the years in that time window. And the win-loss ratio, that is the number of the dollars that were made on the winning trades versus the losing trades, was proportionately very attractive as well. So, and here we are coming into a long weekend. It's a funny one in Canada, but just a classic one in the U.S. for the 3-day weekend, where you tend to see strength. So this momentum that we've been building, it's very common to be looking for it right now. Probably has another week or two, maybe, as I say, maybe out to the 18th or so as far as the S&P is concerned. And then we get into a window where we need to be careful here, because a correction into August, if we don't hold good support, and we've got some technicals that we're going to look for at the time, some moving averages and things, if we don't hold in August, then we could be looking at a pretty sizable correction. Now, the NASDAQ, interestingly, has a very specific pattern that we look at. Starting from the October low, we look for a DeMark sequential combo pattern, which means that you look for nine consecutive weeks with the market above 4 weeks earlier. Then you get into this countdown phase where, as you put in higher highs, you do eventually end up with a 13 count if the market is progressing higher. That pattern completed as of this week. And this is now the 7th time since the 2009 low that we've had this pattern kick in. And all but one of those had a pretty decent correction, somewhere between a minimum of 6% and a maximum of 20%. So the NASDAQ, as I say, is probably the one that might have the biggest vulnerability here. And just any downside reversal, once we get into the middle of the month, I think you want to be extremely cautious going into this fall.
Crude oil still climbing?
Still climbing, nice and steady. This is where our time window for a high here was going to be into July or possibly out to October. The $75 level that we've gotten to now is sort of, it's no man's land for us. 72 to 73 was an initial resistance area. Pushing through there, there's not much until we get over 100. So somewhere around 103 would be a really good spot if this thing just decides to go into a euphoric run on the upside. The weekly chart has gone overbought for the first time in years, so if it doesn't gain some momentum, we could have a small correction. For now, 71.5 looks like a pretty good support level, and we'll see how that manages to hold. Now, natural gas, we had a good signal with the commitment of traders numbers the better part of 3-4 weeks ago when we were down just over $3. And what we look for there is to see if the non-commercials, that being the speculators, reduce their positions quickly, and that type of action, when they reduce their positions and the commercials do manage to stay with theirs, that really tends to spark the market having put in a low. So historically, we looked at it, the run was anticipated to take us up to about 380, and that was reached as of this week. So I think, unless this really becomes an exceptionally hot summer, the 380 was a reasonable target, and probably look for it to come back maybe towards $3 again, and we'll see if we can come up with a new recommendation on the long side.
Is there still hot action in the commodities?
In the commodities as a whole, yep. The grain markets jumped up really nicely after being oversold. Soybeans, we got a great oversold low there. And the November contract has retraced about 80% of its losses. The ETF, the SOYB, also retraced 80%. But when we look at how high these grains are relative to, say, the last 50 years, I'd be a little leery now. I mean, it was a great bounce to trade from for this move up, but I think I'd be hesitant to do anything new over there. In the precious metals, a great pattern developing there as far as the gold is concerned. We had the capitulation low 2 weeks ago. We went down in a consolidation this week, just marginally took out that low and then turned on a dime. Just a classic type of gold bottom. So probably looking at something up in the 1830s as a reasonable target for a bounce there. And silver managed to hold its lows, not break down. So silver's probably got a little better upside bias than the gold right now.
Ross, do you have any special offers for our listeners?
Well, we're down to the last few days on our special, so if somebody wants to go to the website, 25% off the annual subscription, but that will be coming to an end in the next couple of days.
Ross, thank you so much for being on This Week in Money.
Nice to be with you, Jim.
My guest has been Ross Clark from chartsandmarkets.com. You can find him on Twitter at ChartsByRoss. Coming up, Victor Adair, next on This Week in Money.
Always consult your investment professional before making any investment decision.
Engineer Gold Mines is focused on the exploration and development of the historic high-grade Engineer Gold Mine situated 32 kilometers southwest of Atlin, British Columbia. Engineer Gold Mines is fully permitted for surface and underground exploration with the drill program now underway. Engineer Gold Mines Limited trades on the TSX Venture Exchange, symbol EAU. For more information, please visit us at engineergoldmines.com.
This Week in Money is archived online at talkdigitalnetwork.com.
Welcome back. My guest is Victor Adair. He's recently retired from nearly 50 years of being in the brokerage business in BC. His website, VictorAdair.ca. Welcome back to the show, Victor.
Jim, good to be back, and it's always a pleasure to talk with you.
The North American stock markets hit all-time highs once again. What's the story there, and will it go on forever?
Oh, I think going on forever is an understatement, Jimmy. That's all we need to know. Stocks only go up by as much as you can possibly get your hands on. Next question, please. Yeah. The S&P is up about 6x from the 2009 lows. You know, $1 is worth $6 now is what I mean by that. And that's not counting the dividends that you would have received during that period of time. It's nearly doubled from the lows that we had in the, the panic COVID crisis of March of last year. You hear, we live here on the West Coast, and for years and years and years, we've been hearing all kinds of people talking about the runaway real estate market. Prices are goofy, they're ridiculous, the market's bound to crash, and so on, and here it is making new all-time highs. But it doesn't hold a candle to what has happened in the stock market. Now, I will grant you that in the real estate market, you can play, if you're a speculator, with a lot more leverage than you can in the stock market, but really, the run in the stock market has been spectacular since the end of the great financial crisis in spring of 2009. But one of the things that's been happening is that the yardstick we use to measure the stock market with, a dollar clearly everybody knows doesn't buy as much of anything as it used to. So like everything is going up in terms of dollars, the stock market just going up a lot more. Bob Hoye, who I know is a dear friend of mine for years and years and years and a frequent guest on your show, he likes to say that the public will choose what they want to speculate in. So these days it seems they speculate in stocks and real estate and commodities and crypto, baseball cards, but they're buying everything. They're not shorting anything. It's always a buy. There has been an absolute tidal wave of money come into the major stock indices, stock markets here over the last, certainly the last year from the COVID crisis. We are clearly in a momentum market, not a value market. That means, people are buying stuff because it's going up, and you buy it, it goes up, so you're happy, you buy some more. So they're not buying something where they've, really sharpened their pencil and thought, okay, we're getting a real good deal here, let's buy this thing. No, they're buying stuff because it's soaring in prices. These soaring prices are good for people who own assets, generally wealthier people, and let's face it, also pension funds. I mean, for a couple of years there, the talk was, gee whiz, the pension funds are just not growing their assets to meet the future liabilities they have. We're going to have a major problem here. Oh, the stock market's smoking to the upside. At least the pension funds are in better shape, and that's going to benefit everybody to some degree. But this, the fact that wealthier people own assets and poorer people don't, certainly widens the income, or not income so much, but the inequality scale. We're up, let's say, let's go to time frames. I mean, the S&P last year, when the COVID crisis hit, fell 35% in 6 weeks. That was definitely a bear market, a real scare. The biggest setback that we've had this year in the S&P has been about 4%, like you didn't even notice. We are probably overdue for some kind of a scary break in the market. I've kind of thought that for some time. I've just thought that this thing is really, really run away. It may be the greatest bull market, forever, at any point in time. I don't know. It doesn't matter. I just see that it's been a very strong market. We are making new all-time highs right as we speak. Seasonally, I think going back at least 10 or 20 years, the period of the first 2 weeks of July is one of the hottest periods for the stock market. So probably we get more of the same. But I will be watching, this is me personally with the trading that I do with my own money, I'll be watching for some signs that the market has got a little too giddy and we might get a break, and then I'd be shorting it. But I will not short a market that's making new highs like it is now, so I'm on the sidelines.
For the past 15 months, governments and central banks worldwide have been just pumping money like crazy into the markets, into programs, but there have been hints that central banks might start to pull back. What impact, if any, would that have on markets?
Yeah, we've seen different central banks, and here in Canada, we had the Bank of Canada at their last meeting dial back a bit some of the quantitative easing they were doing. They've got another meeting coming up this month. It seems like it's around the 14th or so of July, and don't hold me to that, but around that time. And I think there's an expectation that they may dial it back a little bit again. Certainly the Federal Reserve last month, was it the 16th or so of June, when they kind of shocked the market. And it's amazing how you can shock a market these days. Because in essence they said, well, it's possible that maybe sometime 2 years from now we might just raise interest rates a tad. Well, the market had a hissy fit, for 2 or 3 days, and then it was all over, and we've gone on to make new highs. The central banks, on the one hand, over the past few years, we've called it the Greenspan put. Like any time the market seems to be getting in a trouble, you phone the fire department, the Federal Reserve, and they come racing to the rescue. Now they do have an opposite duty, and this goes back to William McChesney Martin, who was a Fed leader years and years and years ago, who said the Fed's job is to take away the punch bowl just as the party gets going. Well, it would seem, the party's really ripping along pretty good right now, and the guys that are going to come and take away the punch bowl are nowhere to be seen. So perhaps, if things get really smoking hot, they will try to dial it back a little bit. But the thing here will be, how do you do that without really upsetting the apple cart? If folks are into these markets levered up to their eyeballs, extended out on the risk spectrum probably way further than they should be, and on and on and on. People reaching for yield, I call that. And in an environment like that, if somebody hollers, whoa, and the thing turns and starts to fall, who's going to buy it? So the central banks are in a very difficult spot in terms of, they can't try to cool the party, it would seem. So we'll see. Maybe it'll be some exogenous event, something from outside, like another virus or something that scares the hell out of everybody, and that trips things up. I just think that if they do try to cool the party, that it will be very difficult to do that, to calibrate it just right. Although, of course, bureaucrats always think that they can calibrate things perfectly.
Crude seems to be just like the stock market on a march higher. WTI traded above $76 this week, a 3-year high. And take a look at what's happening with gasoline prices. What are your thoughts?
Yeah, we had April of last year, it doesn't seem that long ago, when crude oil briefly traded in negative prices. We had so much crude oil around and no place to put it, basically, because you can't just put crude oil on a shelf somewhere. The prices went negative, and now we've soared up to $76. I think we're at about a 3-year high on WTI. Last year, it was a case of too much supply, not enough demand. Now it seems to be the other way around. A couple of things in play, clearly OPEC plus, and that's OPEC plus Russia and some others, have been slow to increase their supply, given that they really cut back supply in about the middle of last year. U.S. shale production is down, and of course the growth in U.S. shale production had been scorching hot up until prices broke last year. We have had, here's a bigger picture item, a real drop in CapEx, the amount of money that the companies around the world, or governments in some cases, are willing to spend to bring, these are long-term investments to bring on future supplies of oil. Well, I guess if you're in an environment where, a lot of people are saying we don't want any more fossil fuels being burned ever, and, governments are saying, okay, we'll swear that by 2035 or something, we'll be zero carbon demand or zero fossil fuel demand. I mean, who the hell wants to spend a long-term capex to develop supplies to deliver in a market where you're not wanted? So we might have a situation here where the available resource that's known and let's say that you can actually get out of the ground and pump around will continue to decline in the face of rising demand. So it's the classic supply-demand imbalance, and it's a classic case also of the price being set at the margin. I mean, let's say, give or take a few barrels, we're at around 100 million barrels a day of production and usage. Actually, the numbers seems to be a little bit below that right now, but the difference is here. $1 million more or barrels more or 1 million barrels less probably means $10 in the crude oil market. So that difference in price gets set by a very modest change in total production and total demand. It's like the stock market also in terms of momentum. The market just been steadily marching higher. One of the things that I pay very close attention to is the forward strip. In other words, right now, a barrel of oil for delivery in September is around $74.50. That same barrel of oil for delivery in December is $3 cheaper. That's what we call that forward strip. Let's say 2 months ago it was maybe $1 cheaper. So the demand for oil right now, not 3 months from now, but right now, is so strong it creates that kind of a curve. I pay very close attention to that backwardation curve just as an indication of how strong supply-demand is. I think maybe, like stocks, we've run a bit too far too fast in crude, and the market's vulnerable to a correction, but at the same time, I'm not going to get short a market that's making new highs. So I'm watching and not pulling the trigger on that trade.
Gold had its worst month in 5 years in June. In previous interviews, you made the point gold's been the opposite of the U.S. dollar, turning up when the U.S. dollar went down and vice versa. What's the story behind gold right now?
Yeah, that has really continued. I mean, just this year, for instance, at the very beginning of the year, the U.S. dollar made an important low. Gold made its high for the year. Then we go to late March. The U.S. dollar turned down and trended down for the next couple of months. Gold trended up for the next couple of months. And then since the end of May, U.S. dollar has been strengthening and gold's been going the other way. So gold has had a very strong negative correlation with the U.S. dollar this year. I mean, I've been trading gold for 50 years. And throughout that time, gold has had a negative correlation with the U.S. dollar, and it kind of ebbs and flows as to whether it's really the main thing or not, but certainly right now it's been very much that way. I think the gold price rallied about $200 in March and April. I should say from the lows at the end of March and April through to the May high, as the market was kind of consumed with the inflation-reflation story. But when then gold couldn't take out the highs we made the first week of the year at about 1950, the market seemed to run out of upside momentum, and it started to tip over, and that's when it got nailed with the surprise from the Federal Reserve when they indicated that, maybe, if everything's hunky-dory, 2 years in the future, they'll raise interest rates a little bit. Gold fell $100 in 3 days. And a good friend of mine who's very, very much Martin Murenbiel, very, very much a global gold analyst. I mean, we were talking, and he said, "This is ridiculous. This is a huge overreaction." I said, I understand it. I agree. But, it is what it is. And part of that I think, was just positioning. When we talked last year about gold, I frequently referenced the massive buying of gold ETFs, primarily in North America and Europe, but, around the world, although North America and Europe were 90% of it. Speculators bought gold. Now, gold's not working for them. They're quick to throw it over the side and do something else with their money, like, buy real estate or buy stocks. So gold really got hit pretty hard here. As you were saying, I think it was its worst month in about 5 years. And I think we probably blew it out to the downside following the Fed news. And the market's sort of been sideways here, I guess, is the best you could say, the past couple of weeks. So speculators who had been long of gold, plus selling, and then plus the U.S. dollar rising, it was just a toxic environment for gold, and we had a good washout to the downside, really. I have been shorting gold, and I covered the last of my shorts today. So I just have, on a very short-term basis, and we can talk about timing as we go along here, but on a short-term basis, I think that was the thing to do, and I'm inclined to think the flip side of that is also that the U.S. dollar, which has been strong the past 3 weeks at least, may be having a little bit of a turn.
Taking a look at the Canadian dollar and how it relates to the U.S. dollar, because that's how we always measure it. The Canuck buck fell to around 68 cents during the height of the COVID panic in March last year. Then it rallied to 83 cents, dropped to 80. Do you see that 3-cent drop as something that's going to continue, or is it just a minor correction?
Yeah, well, you covered a lot of ground there very quickly. The 68-cent low we hit during the COVID crisis was basically the lowest we've been for the last 20-odd years. So Canada got hit really hard. So we got in a hole. That's what I'm saying. And let's go over this as well. Over the past couple of years when we've talked, I talk about what are the things, the variables that impact the Canadian dollar price. One is the strength or weakness of the U.S. dollar. Well, certainly in the whole for the Canadian dollar last spring, the U.S. dollar was very strong because when the world is fearful, money rushes to the safety of the U.S. dollar. Since those lows of last year, when commodities by some indices were at 50-year lows, commodities have had a strong rally. Stocks have had a strong rally. I'd call that a pro-risk environment. So that's just a wonderful world for the Canadian dollar. You've got a weak U.S. dollar, strong stocks, and strong commodities. That's a very favorable world for Canada. Historically, again, just like the U.S. dollar and gold have a correlation, Canada is very positively correlated with commodities. If you take a 20-year chart, put it up on the wall, and it's got plots of the Canadian dollar and the commodity indices, you stand back a distance and look at it, you can't tell them apart, is really what I'm saying. From time to time, interest rate differentials between Canada and the U.S., let's just talk that, cross rate, are important. Again, I'd say historically, Canadian interest rates have been higher than U.S. interest rates most of the time, and that was good for Canada. I mean, if our interest rates had been lower than in the United States, money might leak out of Canada and go to earn higher interest rates in the United States. But since those lows, in March of last year at 68 cents, we've had this bullish environment in these other things that influence Canada. And beginning in November of last year, and November of last year was a magic date in a lot of markets, Biden got elected, and like 2 days later, Pfizer announced the vaccine. So that was a major kickoff point for a number of markets. Since then, that steady rally that the Canadian dollar had been on continues. Canada at that point traded above the highest levels it had been in the past 2 years, and that created an environment where a lot of speculators came in and started buying the Canadian dollar. It was going up on its own merits. it was also an easy way for people to trade the commodity market. You know, the story was there's a big bull market in commodities. Oh, well, how do you buy that? You want to buy hogs and, you know, and sugar and cocoa and stuff like that? No, you just buy the Canadian dollar. It's highly correlated with commodities, as I was saying moments ago. So we had this, what became a very large speculative position in the Canadian dollar when we got up to about 83 cents. That's when I started turning very skeptical on Canada, thought it was, the fancy word is there was an asymmetrical risk-reward ratio. In other words, I thought I could get short Canada and just risk a little bit of money, but if I was right on the trade, I could make a lot relative to what I was risking. So I shorted Canada in the 83 cent area, or traded it from the short side to be more specific. And I covered my short positions in Canada today. I didn't cover them at the very lows, but I think Canada's maybe going to have a little bounce here. To go to your time frame, you know, the rally off of the lows of March of last year, is there more to go? It is going to depend on the U.S. dollar, stocks and commodities. You've already heard me say I think stocks and commodities both look a little extended to the upside. So I'm in the Canadian dollar trade on the long side, you know, on a short-term time frame. I rarely have an opinion about, you know, where we're going to be 6 months or 12 months from now, because you know, that's just coffee table chatter. It doesn't do me any good in terms of trying to manage my trading. I'm much more focused in what's going to happen in the next few days to few weeks. So I think Canada's had this great run to the upside. Just as a technician looking at it, I think we've had a correction here. It'll probably rally back. Where it'll get really interesting for me is if Canada now rallies back a bit, but doesn't take out the 83 cents, and if it rolls over and starts to go down, that's one of my favorite kind of price setups, where a market has rallied, sets back, has another run at the highs but can't make it, and then rolls over. I mean, I want to short those markets all the time.
The leading commodity indices have had their biggest rally in decades since the pandemic lows in March of last year. Some analysts are talking about a commodity supercycle. What do you think?
Yeah. Can I quote Bob Hoye again?
Well, Bob's our next guest, so he won't mind.
Bobby and I have actually been friends for 40 years, and I attended his 70th birthday party, and I think that was about 50 years ago. Anyway, Bobby likes to say that people will believe the most preposterous stories so long as the price keeps going up. And he loves it when I quote him on that, because I know that's one of his favorite lines. There have been some incredible stories about the commodity market. I mean, let's go with copper. I mean, it was a fabulous story. If you were a stock promoter, it was a dream story, you know. We have got shortages of copper in terms of it takes forever to get a mine into production, and some of the countries in the world where we get copper from are, you know, not politically stable, and who knows what's going to happen there. And then on the demand side, it's, oh my gosh, this couldn't get any better. You know, we're going to have EV cars, and we're electrifying this and electrifying that. You just can't go wrong buying copper regardless of the price. Okay. I mean, when I hear those kind of stories, I just start to lick my chops. It's like, oh boy. When people are coming in and they want to buy stuff and they don't care what the price is, I want to be a seller. I'm exaggerating, Jimmy, to make a point, but we had something similar in lumber. I mean, for 30 years, lumber traded between $200 and $400 a thousand board feet, and then suddenly, boom, you know, we went to $1,700. And by the way, in the last 2 months, we've dropped back to $700, a $1,000 drop in lumber. But it was one of those classic supply shortages. You know, we talk about bottlenecks and supply chains and so on and so on. The lumber makers kind of shut down the mills, not totally, of course, but let's say reduced production, thinking when the virus hit, you know, who's going to be building houses or buying houses or whatever. Well, we know the story since then. the commodity super cycle story. One thing I can tell you for sure, and that is commodities are cheap like borscht compared to stocks. And I know I wrote and published a piece toward the end of last year making that point exactly. I thought that at some point that there would be an arbitrage where people would say, the stocks that I own are hugely fully valued, to say the least, and they're giving commodities away on the other side of the street. I think I'll sell my stocks and go buy some commodities. So I think there's some legs to that story, that we could see money going into commodities just because it's so cheap relative to stocks, which seem to be so expensive. Again, I was saying earlier, I don't try to have a view from a trading point of view on what's going to happen between now and 12 months from now. I struggle to know what's going to happen between now and 12 hours from now. Who knows? So, yeah, I hear stories, and stories can have great legs. I mean, look at the crypto story. I mean, it's really captured a generation. Just like, by the way, to be fair, how the gold story captured a generation of people my age. I'm 71. I was just 30-something when people were lined up around the corner to buy gold because they just had to have a bar of gold, and we ran from $100 to $850 in about 8 months. The commodity supercycle. I think things go through periods where they're in demand and other periods when they're not in demand, and you just try to find what period you're in. Right now, stocks are real hot. Commodities are on the indices, and by the way, there are several different indices to measure these things, but the commodities have had a great run here for 15 months. Presently, I'm long the Canadian dollar, so I guess, after having been short, so maybe I've changed my mind on commodities. I think there is a bull market in commodities, but I think the one that would be more interesting to me would be the bull market in commodities compared to stocks, as opposed to just commodities as a bull market on their own.
You've been trading currencies, looked after interest rates, stocks, and commodities for nearly 50 years. What's your overall advice you can give people? Is it something you have to do individually, set your own targets, and so on?
Well, that's a pretty open-ended question. Here's a way I frame it on my website, and I talk about trading, and that is, I'll say, here's what I do, and this is what works for me sometimes, and that doesn't mean it's the right way to go. It's just, through trial and error, this is kind of what I've come up with. And I do believe that everybody has to find their own way and be prepared. I mean, it seems to me it would be unlikely that you would become a stock market genius just because you decided, you're going to become one. It's probably going to take years. The learning never ends because markets keep changing, you keep changing, the world keeps changing, so on and so on. But some really generic views here. One would be that making money and keeping money, and those are two different things. Making money and keeping money, I think, is a result more of how you manage risk than whether or not you've got a great crystal ball. Risk management, for instance, would be sizing. If you're going to buy something, how much are you going to buy? Limiting your losses. Okay, you bought something because your buddy said for sure this is going to go up. Well, you bought it and it's going down. How long are you going to hang on? Are you going to let it go to zero? At what point, if it's going against you? Or, by the way, are you going to just increase your size because if it was a deal, last week and it's cheaper now, you should buy more? And believe me, that's one thing I just don't do. One of the sort of golden rules is never, never, never average down a trade. Just, you bought it, just admit it. You're wrong. It's not a big deal. What you want to do is try to hang on to things that are working and don't hang on to things that aren't. Another thing to pay attention to is concentration. You'll hear people talk about diversification. Wonderful idea. But I'm going to tell you that if you are long stocks, long commodities, and long the Canadian dollar, it's all the same trade in today's world. You know, give or take a little wiggling around here and there. But concentration, you got to watch for that. You have to have contingency plans. What are you going to do if? And if you don't know what you're going to do if, then you will probably inevitably get hit with a painful whack that'll train you, that you need to have contingency plans. It's a marathon. It's not a sprint. And one of the things that seems straightforward, but my golly, I'm going to tell you, I keep falling into this error myself over and over, is to keep the time frame of your trading in sync with the time frame of your analysis. I can have a view that, say, the stock market is overvalued on a multi-year basis. Okay, that's a long-term time frame. But then if I start poking at it, with short positions, with a short-term bias, I'm way out of sync. And I mean, that's just an example of how you can be out of sync with your trading and your analysis. Another classic is, you buy something for a flip, whatever it is. You're going to buy it with the intention of, it's going to go up, and probably by next week you're going to sell it and take profits. 6 months from now, you still own the thing, and of course, it's worth less than what you paid for it. At some point, just kick it out. Dragging old stuff like that around is really is not helpful. One last thought, and this just occurred to me. I have a bookcase full of books that I've read over the past 40, 50 years on markets, and I've seen some of the how to get rich quick videos on YouTube. I would say read the books, forget about the videos. What I've seen, a lot of those folks don't have any idea what they're talking about. They're just trying to sell you something. And that kind of goes, I've seen a lot of marketing pieces dressed up as research, and I think that's dangerous. Anyway, you gotta lose money to learn how to make money, and so, plan for that, and just have an objective and keep going.
Victor, thank you so much for being on This Week in Money.
Well, thank you for having me on. Please say hello to Bob Hoye if you're talking to him later, and for me, and tell him I quoted him a couple of times. You'll get a giggle out of that.
My guest has been Victor Adair. He co-founded the Polar Futures Group, if you're wondering about his background, by the way, and why you find his name so recognizable. His website, victoradair.ca. And coming up next, we'll have Bob Hoye on This Week in Money.
Don't miss out. Stay informed. Receive the HowStreet.com weekly recap with thought-provoking podcasts, radio, and articles delivered to your inbox. Sign up for the HowStreet.com weekly recap on our homepage at HowStreet.com. This Week in Money is archived online at TalkDigitalNetwork.com.
Welcome back. My guest is market historian Bob Hoye. He's the chief investment strategist for chartsandmarkets.com in Vancouver. Welcome back to This Week in Money, Bob.
Jim, good to be with you and with our listeners out there.
Our show today will take a look at 4 listener questions. Bob loves to answer your questions, so you can send them to info@howstreet.com, and he'll be glad to answer them for you. Please try to keep them as brief as possible. Our first question comes from Kathleen. She's a regular listener, and we know somewhere in her question she'll have a musical reference, so let's take a look at the email. Hi, Jim and Bob. It seems like Fed Chair Powell is signaling to the retail public that they can borrow at near zero interest rates and then invest in ever skyrocketing asset prices as the Fed promises to stoke inflation. Every time he speaks, he might as well be playing the 1957 hit by Frank Sinatra, Come Fly With Me. I heard one analyst who was apparently flying with Chairman Powell say that we are only in the parabolic stage and haven't gone into the vertical stage as yet. Bob, is Chairman Powell flying by the seat of his pants, or does he have a specific flight destination in mind?
Right. Okay, Kathleen. Now, one of those recordings by Frank Sinatra with come fly with me, and they're flying to Reaugh, and he closes with, and don't tell your mama, which is kind of fun. And the question, of course, the Fed is determined to keep the boom going, because they know without a boom, things are going to get kind of ugly. And there's the last few months, the street, and as you point out, even the guys at some of the big banks are saying that this is just the start. Now, and it's the old 1970s type of inflation they're talking about, which is the one everybody understands. The Fed is crazy, the Fed is reckless, and it depreciates the dollar, and commodities are going to go up, and inflation's going to come back. And these guys have not had a good track record. So what is missing in this recipe is that you get into a decade where the inflation is in financial assets, stocks and bonds. And if you look at the action, say, in the Bitcoin crypto sector, the price gains on items of, huge market cap have been without precedent in history. So, the action is in stocks. The other side of it is in bonds. And you've had the German 10-year note go down to almost minus 1% on the nominal basis. And minus interest rates nominally have never, ever happened before. So the price of the German 10-year notes got bid to infinity. So, and so you've had a terrific rally in base metals and now getting some action in crude as well as the grains. And but we take this as the rise in in industrial commodities as the boom, the business boom with a great financial mania concludes. So when you want to talk about rising commodity prices, you've got to go back to 2011 when, well, for example, we did copper, lead, zinc, nickel on a deflated price basis on a 100-year chart. And it was the greatest gain in 100 years to that point. And not only the greatest, but the magnitude of the gain was unprecedented. So that period, the commodities ended in 2011, which then sets up a decade of speculation in financial assets. So count it out, and this is the year that we're likely to see the market go crazy, and we have, and likely within this to be strong into mid-year, which we're getting. But we're seeing some adversity developing, and consider that the track of speculation is probably climaxing and will be followed by the usual recriminations of a contraction. So things can be okay into August, but then after that you got seasonals on a lot of things that can bring it down. Good question, Kathleen. And it's going to overwhelm all of the central banks, and including, I think the public's going to condemn that the Fed has taken effectively taxpayers' money and thrown it into a speculative market. But as to the chairman flying by the seat of his pants, yeah, they're just going on intuition, because the theories have never worked of successful intervention. You've had 18 cyclical recessions since the Fed was formed in 1913.
And the whole job of the Fed was to prevent recessions and depressions, right?
That's right. Doesn't work.
They should all be fired.
Yep.
Bob, we have a question from Michael. Some analysts are predicting a 10% correction in equities in July, followed by a parabolic move higher into 2022. Others are saying that we're already at the top and that the markets will sell off 10% at first and then gradually step down through 2022. Boy, going in two opposite directions there. But what happened to that 50% crash that many were anticipating just 15 months ago? I think a little thing called a pandemic stepped in, Bob.
Yeah.
Bob, will the markets experience a series of manageable downward corrections going forward, or should we prepare for a 1929 or 2000 style crash?
Yeah, Michael, this has been the greatest financial bubble in history. And all of them were followed by severe contractions. So this is the probability. Improbable is to go into like most of them are calling for, a world of inflation. And the other is that the amount of speculation has been huge, and the correction, it will be according with the degree of speculation that set up these incredible prices. Yeah, it's time to be building liquidity and to be very cautious.
Bob, what I'm thinking, if it's a step down, and I suggested this to Tim Cyclesman Wood as well, I said, isn't that really the most dangerous kind of correction? Because people keep expecting the market to do better. They put money in, but it steps down a little bit. They put more money in, and then you find out after 2 years you've lost a lot of money. But, you know, it was kind of, I guess, being smothered gently to death. You're still dead.
Oh, you got a point there, because in a lengthy bull market, you buy the dips. And in the subsequent lengthy bear market, you sell the rallies and don't buy the dips. So there's a fabulous headline from early September 1929, and it does review that investors had learned, and they didn't use the term then, buy the dips, but effectively that's the one I'm going to use, is they had learned that if you bought every dip, you were on side. And then within our technical work, we've got a technical tool which, on a decline in a rising market, gives what we call a springboard buy. And that's on your dips. But then you always have the problem of which is the last springboard buy in a lengthy bull market. Well, you don't know until the level of the last buy is taken out. And I think that will occur in the fall.
From Denis Reaugh, or Rock. Thanks again for your excellent show. I have a question for Bob. Have all major financial manias ended with an inverted yield curve before a collapse in the stock market?
Good question. The yield curve is important, and just so our listeners know, it's the difference between short-dated and long-dated bonds like treasuries. And in a boom, short rates will rise faster than long rates, thereby ending up with the inversion. And I've got the yield curve back to, I think it's 1857. So you cover any number of bull markets, and you also cover the 1873 bubble. And the rule of thumb is that curve inversion will be followed by a recession. The other is that in 1937, the curve didn't fully invert, but it was followed by a recession. But if you look at it, as I've got all the way back, it sort of is loose. And who knows whether the curve will invert now. I mean, it did last year. But I think it's not, it's a condition that you look over your shoulder and say, yeah, it happened. But it's not a guide for trading. A better guide to trading or positioning is the credit spreads, which is the difference between high grade and low grade bonds. Now, the narrowing of spreads shows confidence, and spreads have really been narrowing, but there's a seasonality to credit spreads, and they can narrow into May or June, which we have had. They're still narrowing, but this is part of the party that was likely to run into mid-year. So the ones we're watching for would be further weakness in commodities, the yield curve, the credit spreads reversing to widening. In the CCC, it's not, but if you take a look at the items that trade like J&K and TLT for the treasuries, there's a bit of change going on there. So at the moment, the yield curve would likely have more influence than credit spreads would likely have more influence than the yield curve. So again, we figured the party would run into mid-year, called it the sunshine period. It would turn to twilight in August, and then possibly the twilight zone after August. And I don't see anything to change our view on this path working out.
Bob, now I have a question here. It relates to Bitcoin. Binance, global company that trades in cryptocurrencies, is pulling out of Ontario and won't be servicing accounts there because Ontario plans to bring in regulations to deal with cryptocurrencies. Now, Thailand and the Cayman Islands are saying that perhaps that Binance might even be under national security regulation investigation for trading without a license. Is this the first shot really being taken at cryptocurrencies and from the side Bitcoin by governments?
Yeah, it's become the biggest mania in history, and I think at some time the blockchain stuff in Bitcoin will become useful at some point, but really, the way I look at it now, it's just chalk marks on a speculation board. It's just a game to play. It's the equivalent of tulips in Holland in 1637, or the bucket shops in New York in the early 1900s, where they had walk-in customer rooms and they had a chalkboard up there with the stock symbols. And they would they'd have a board marker boy to put in the quotes and whatnot. But the bucket shop did not, you put in an order, it was like a wager that the stock would go up, so you're long, or the stock would go down, you're short. But then there was no a transaction done on the exchange. So it was just a place to speculate in chalk marks on the board. And these cryptocurrencies are just very strange critters. And they cost huge amounts of electrical power. Harvard Business Review a while ago did a study and figured a year or so ago the annual drain of power was equivalent to what Sweden uses. And so, no, it is one of the greatest financial items in history, and my guess is that once the price breaks even further, those who are running these very expensive mining machine computers, whatnot, are going to say, "Hey, what is this?" And I think it'll contract really quite severely. So, and yet it's very hard to short because all of a sudden these things move like mad. So for me, it's something to watch.
Bob, some headlines that caught your attention. Here are two that have to do with real estate. U.S. home prices surge in April at truly extraordinary rates, and the pandemic boom in the U.K. has home prices there going up in price the most since 2004. What's the story?
That's it. In previous financial bubbles like 1929, there was a terrific boom in residential real estate that went with it, particularly in Florida, and that one then collapsed severely. So anyways, you do get a speculative move in residential real estate, which we're getting. And I think it's going to be the same thing. Once the whole party is over, then home prices are going to head south.
An IPO, and this has been the year of the IPO. Krispy Kreme delivers a donut hole to investors. Apparently its IPO was not as sweet as expected.
Yeah. It opened below the issue price. And Krispy Kreme, I remember that name from years ago, a big donut distributor. So anyways, that was a good headline. But I can remember in Vancouver, I was with a very good regional broker on their institutional equity desk, and that was a party in new issues, or as they now call them, IPOs. And my gosh, they're coming out and doubling or tripling. And then everybody had to be in, so we could see the footprint of very aggressive retail accounts. So they would maybe put in an order for 500 and get 100. So then they would double up their orders, and then there was one guy who was really aggressive, and he'd go to the trust companies in town, have an account there, and put in orders there. And then each time he'd only get a small amount of stock on the allotment and would complain. And then came the one that ended the mania. It was electronic data processing, EDP, I remember it. And that was the one that was the turkey. And this guy got not only to get his orders filled in the brokerage firm I was with, but he got filled at all of the trust companies he'd opened up accounts at. And it probably took away all the gains he had made in the previous year and a half. So this is where I think the Krispy Kreme is interesting, is that the initial trade was not above the issue price, and it'd be worth watching. I'm going to do a little more investigating into it, because it's just going to be another colorful story. So,
an item that caught my eye today, Bob, was Robinhood, the trading company that's looking for everybody who likes to trade off their smartphones.
Oh yeah,
they're looking to do an IPO. Are they getting in too late for that, or will they take off because they've been so popular?
I don't know
with
whether
the day
they'll
traders?
make it or not, but all the better for them. I mean, you got a crazy market, float your stock and do a secondary and get rid of some of your own stock. It's a terrific idea. Now, how much will be taken by the public and how enthusiastic they are about it, I don't know. But it's going to be interesting to watch, and they might, if they're going to do it, they should be doing it right now.
A lot of people were cheering for the Reddit gang, the people who boosted the stock of GameStop and AMC and so on.
Yeah.
Cheering for them against the big hedge funds. Should we be cheering for them, and should you be picking sides when people's, pension funds and so on are on the line?
Oh, no, I would look at it as a student of the market, where you have fabulous events going on. And now also there's potential for an irony in here, is that the Robinhood Reddit crowd could buy the issue themselves and get hung up with it. Now that would be lovely. Now there was an ironical one in 1929 where Goldman Sachs had everybody was doing trusts, floating trusts, where then they would buy other stocks, and it became a kind of a leveraged up thing. So they raised an issue that was then going to buy all the stocks and run their portfolio. But before they, it took quite a while to get all the cash in, because who knows what settlement day was, maybe 1st of September of that. So they got the money in, and then the market started to break, so they didn't invest it. And you had this fund that was fully in cash and listed trading, and it traded at a huge discount because people who had bought it just wanted to get out. And what risk was in it? It was all cash. So very strange things can happen at the end of a financial mania.
Bob, thank you so much for being on This Week in Money.
Hey, Jim, good to be with you, and we'll look forward to doing it again.
My guest has been market historian Bob Hoye. He's the chief investment strategist for chartsandmarkets.com in Vancouver. And that wraps up our show for this week. We'd like to thank our guests, Ross Clark, Victor Adair, Bob Hoye, and thank you for listening. Now, we have all kinds of experts that are on the show. They love to answer your questions. You can send them to info@howestreet.com. Now, stand by for a company showcase update from American Manganese CEO and President Larry Reaugh. I'm Jim Goddard. We'll be back next week with more This Week in Money.
Comments made on This Week in Money are an expression of opinion only and should not be construed in any manner whatsoever as recommendations to buy or sell any financial instrument at any time. Archived online at talkdigitalnetwork.com. This Week in Money is a production of Howe Street Media Incorporated. Executive producer is Tom Allen. Welcome to Company Showcase, an advertising feature on HoweStreet.com.
I'm Jim Goddard. I'm speaking with Larry Reaugh, CEO and President of American Manganese. Welcome back to Company Showcase.
Thank you, Jim.
Larry, a couple of news releases from your office this week. Was the news as hot as the weather?
Yeah, I think the releases were fantastic. They were kind of back-to-back, which is not the way we like to do it, but this is the way we received it, so this is the way we put it out. And our first release was June the 30th, June the 29th, and that was the release on the NMC 532 Cathode Precursor and from recycled NMC cathode waste. Well, what that's telling you is that older chemistries out there, we can treat and turn them into the newer chemistries. Simple as that. And, we have a process that goes directly from cathode to cathode, which includes now the morphology of the size of the particles, and this bypasses a lot of steps that have to be done from a miner or anybody else producing the cathode materials. It has to go to a chemical treatment, which is a cathode supplier, and all this stuff costs money. And of course, the big markup goes to the cathode supplier. So we can actually set up on a site, do everything that a cathode supplier, and any recycling that's out there, and get these high, close to 100% purities and recoveries. And so it's a breakthrough as far as we're concerned, and it's basically puts us as a pioneering company out there, as far as I can see, in the lead. Although I do read other press releases that sound like they're pretty much copying what we're saying and saying they can do the same thing. But I can tell you, it's not that simple. It's a lot of back-breaking work, R&D, and expensive work. And so in order to get to the actual end product, can be a very treacherous path and also a very expensive path for most of the miners, for sure. I mean, they're going to get the quoted price on the LME, and then they've got to pay for the treatment, and that's usually done in China, by the way. So it's a vicious circle that China has set up, and they've got everything coming to them. And what we can do is we can bypass all that. So that's a big feather in our cap. Now, the second release on the 30th was the allowance of the Japanese patent, and I have to say, the Japanese are probably one of the more stringent countries to try and get a patent through. And for us to get this on the heels of the Korean patent, we're in battery manufacturing territory. So that's another excellent situation. I mean, you can read everybody else's releases. They talk about patent pending. They talk about having patents, although you can't find them. And, it's just a game of, trying to knock down the guys that are actually showing what they can do. And, that's us. I mean, we're very transparent. I get questions like, what does Cometco own in the patents? What do they do this? What do they do that? Cometco has hundreds of clients. We're not the only client that they have, and they've got lots in the mining business. They do a lot of work on solving problems for concentrators out in the mining, and they're doing that same work for us, but that doesn't mean that they own anything in the concentrator. They're paid contractor, and we're lucky to have the A team working on our project. What can I say? It's all arm's length. Everything's transparent, and yet people come back with the question of what does Cometco own? Well, I can imagine where those things evolve from. If you look at the market today, you'll see that they're trying to force us down, and on the back of two excellent press releases. And, that's our predators. They're out there to make themselves money and to take it out of your pocket. Just remember that. That's all I'm going to say about them. They come up with, I'm going to say one more line. And that is that they hire guys out there to go on the boards and bash the company, and most of them don't have any background on what the company does. They just bash it. That's as simple as that. So I'm hoping that most of our investors have been following everything I've had to say about them. The downtick today, it's not closed yet, so I don't know exactly how we're going to close the market, but the downtick today is typical. The volumes are way up, between two national holidays. You'd expect volumes to be low, and the prices have been knocked down. And, that's an arbitrage between the U.S. and the Canadian markets. Very little change of ownership as far as I'm concerned. That's my opinion, that a lot of this stuff has no change of ownership. If it does, it's only for 24 hours or 48 hours, and then it goes back to the original guy. And but usually they'll downtick it that way. And they've got a setup where it automatically happens. And, they can leave the board and get ready for the long weekend. And that's it for U.S. We've had our holiday yesterday. And so it's all I can say, guys, is, when you put out two excellent releases and you see the market going down, I don't have to paint a picture of predators for you. It's certainly not shareholders that wait till 11 o'clock in the morning to start knocking the stock down. These are, it's not investors, I should say. These are predators. And, and it does tick me off. I mean, it's been going on for a long time, naked shorting since the 90s, and then getting rid of the uptick rule in Canada, actually, they proposed it in 2011, and the stock fell over a cliff. So, and they finally imposed it in 2012, and it doesn't look like they're going to do anything about reinstating an uptick rule to protect investors. It's just not in the books, as far as I can see. So, all I can say, guys, is, this has been a great week for us. Two bridges crossed. We have with the Japanese government and the results from taking older chemistries and turning them into new chemistries without any change in the cathode structure. So, or there is a change in the cathode structure, I should say, but it's a positive change. It's changed from a older chemistry to a newer chemistry, and that we have capabilities of doing. So it's basically, it's been a holiday yesterday, so that's all I can talk about is the press releases and the stuff that's coming through. I get all kinds of, basically all kinds of new technologies that are emerging here by the bundleful. Some of them I see are just rerun technologies that they've talked about 2 years ago. And, they're just they're trying to catch the wave, and I don't blame them. I mean, what the heck? But the point is, if you want to do your due diligence, go to our site and see that we've been transparent. Our ownership is 100%, and and we've got a fantastic team of geniuses at the A team at Cometco working on this project. So, what more can I say except for the U.S. investors, have a very good holiday, and we'll see you again on Tuesday.
Larry, for people new to American Manganese, what's the company all about?
American Manganese is a critical metals company and a pioneer in the recovery of low-grade materials and manganese. A pioneer in the development of a recycling program that works. It's that really has put us on the map, and I think you're going to see greater things for us in the future. Now, we have a website out there where you can do your due diligence at AmericanManganeseInc.com. We're traded on the Toronto Venture Exchange under the symbol AMY. We're traded on the QB Exchange under the symbol AMYZF in the U.S. And we're traded in Frankfurt under the symbol 2AM. If you want to talk to anybody here in the office, you can phone 778-574-4444, or you can send me an email at leaugh@amymn.com.
Larry, thank you so much for the update.
You're welcome.
I've been speaking with Larry Reaugh, CEO and President of American Manganese. I'm Jim Goddard. Our conversation took place on July 2nd.
Comments made on Company Showcase are an expression of opinion only and should not be construed in any manner whatsoever as recommendations to buy or sell any financial instrument at any time. Archived online at HowStreet.com. Company Showcase is a production of How Street Media Incorporated.